In this video, we'll be looking at the most common mistakes that almost every retail trader makes when trying to become profitable. In fact, if you yourself are a retail trader, then it's highly likely you're making some, if not all, of these mistakes right now in your own trading. Through the course of these video lessons, we will not only identify these mistakes, but also show you how you can avoid them and, most importantly, tell you exactly what you should be doing in order to make money. The first mistake concerns risk management. You've probably heard about leverage in trading, and maybe this has even attracted you to it in the first place. Leverage allows you to trade with more money than you have in your account, similar to how you can buy a house with only a fraction of the money down, using a mortgage to cover the rest. Of course, using leverage exposes you to the risk of losing more than you have as well as making extra profit. Risking too much in the pursuit of profits is called over-leveraging. Over-leveraging is involved in most retail traders blowing up their accounts. This is because it only takes a small loss to make a huge dent in your equity. The first thing you need to do is stop using leverage. This is simply a temporary step as part of your development as a trader. This will allow you to focus on the process of trading without worrying about wiping your account out. You'll notice a huge difference to your confidence and mindset when you make this small change. But this is only a fraction of effective risk management. It is not just about how much money you risk on each trade. In fact, the biggest way to reduce your risk in trading has nothing to do with money or risk-reward ratios at all. The key is in having the right knowledge so that you simply know what you are doing. Warren Buffett is the world's greatest ever investor, and due to this, he is regularly ranked as one of the wealthiest men in the world. He states that risk comes from not knowing what you are doing. This simple fact is actually what holds almost all retail traders back from ever becoming successful traders. We can illustrate this with the example of rock climbing. If we told you that two people were climbing a dangerous cliff and that one of them would fall off, you may say that each climber has a 50-50 chance of making it to the top. However, if you then found out that one of the climbers was highly skilled and had been climbing cliffs like this for 20 years and he had all of the safety equipment and appropriate gear, while the other person has zero experience in climbing and in fact has never even climbed a small wall, he also has no safety equipment and is wearing inappropriate clothing, would you still feel that each climber has an equal chance of making it to the top? Probably not. Trading is the same. If you have not learned the correct skills and do not have the right knowledge, then it is impossible to build the experience necessary to ever become a competent trader. And if you do not have that valuable knowledge and experience, it is highly likely that you will simply continue in a cycle of losing until you run out of money or give up in frustration. The very famous fact that over 95% of retail traders fail to make money is not surprising at all when most of them are not even learning the correct skills and methodology in the first place. This leads us nicely into the second biggest mistake retail traders make: trying to trade solely using technical-based analysis, systems, or robots. If you have been searching online for information about trading, then you have almost certainly encountered educators that focus primarily on technical analysis. You may have even been told directly that this is all you need, or that every piece of news or information is displayed in the price. Some educators even go as far as to say that news is dangerous and volatile and should be completely avoided. Instead, they present simple-looking systems that do all of the work for you. It makes trading seem easy and simple, and that all you have to do to make money is follow a few simple instructions or even just plug their system in while you sit back and make the money. This, of course, is very appealing to retail traders looking to quit their jobs and make trading their primary income. Unfortunately, this does not work, and this is certainly not how professional traders working in banks or hedge funds operate. You can confirm this for yourself by simply watching the main financial news channels where they discuss the markets and regularly invite guests to share their own views on the markets also. Just note how often they mention technical based analysis as part of their viewpoint. It is virtually nil. Very often you will also see traders at their desks on these programs. Look at what is on their screens. How similar does it look to your trading screens right now? What do they appear to be looking at? The short answer is information. The real mistake that retail traders make is that they fail to pay attention to and apply the correct information in their analysis when trying to find trading opportunities. This information is more commonly known as fundamental analysis. Fundamental analysis is designed to help you understand the reasons why the market is moving so that you can make intelligent trading decisions in line with what the rest of the market is actually doing. Trying to trade purely on price movements with no regard to fundamental analysis is just not how professional traders operate. And if you fail to follow their lead, you are effectively just an inexperienced rock climber doomed to fail. Of course, technical analysis has its place, but you need to understand where it fits in and how to access and utilize the same information that the professional institutions are using also. If you trade solely on technical analysis, then you are effectively trading blind. If you do not know what the rest of the market is doing, or the reasons why the prices are moving in the way that they are, you will quickly lose confidence in your strategy. And this brings us to the final huge mistake that most struggling retail traders are making every day: switching. Switching is when you find a system or strategy that you like the look of, it seems simple, attractive, and you have a feeling that it will give you consistent winners that you crave. Your next step is to backtest this, which seems to show that you will make hundreds and hundreds of pips on a regular basis, day in, day out. You begin trading on Monday morning. Within a very short space of time, the results you get from trading the system live differ greatly from your backtested results. This causes you to almost instantly lose confidence. You then revert back to searching for another system or strategy until you find one. You then repeat the whole process over and over in an endless cycle. This cycle is what we refer to as switching. If you are in this cycle, then you have probably felt at least some frustration with your progress. You will only ever experience losses in this cycle because you cease applying a strategy at the point where you are in drawdown or have experienced an overall loss. Simply repeating this cycle can only ever chip away at your account and reduce your balance, even if you're not using leverage. It may feel like your knowledge of trading increases almost every day, but your performance remains static and poor. This is the direct result of not having the correct knowledge, focusing too heavily on technical based systems, and going around in circles between those systems by switching. If you have been making these mistakes, then the solution is very simple. The key to understanding the markets correctly, avoiding an over-reliance on technical based systems, and ending the cycle of switching is all in starting to learn and apply fundamental analysis. By doing this, you will be following the same processes and using the same information as professional traders working inside funds and firms around the world. The most exciting part is that you will start to see an improvement in your trading almost right away. So if you've been struggling to trade profitably, making the mistakes in this video, and wondering exactly how professional traders operate, then the next video is going to be of great value. We will be looking at the concept of fundamental analysis in more detail and how you can understand the market and build a strong confidence in your trading. In the previous video, we looked at the top 3 mistakes that almost every retail trader makes when trying to become consistently profitable. We also explained how the key to trading like professional traders lies in having a thorough understanding of fundamental analysis. In this video, we will be following on from this by explaining what fundamental analysis is and how you can start to get to grips with it in your trading. We will also include a step-by-step guide that will help you begin to interpret news and analysis into clear trading opportunities. To illustrate how fundamental analysis applies to the trading routine of most professionals, We can use the example of driving a car. 80% of driving is done by looking through the windows and reading the signs to tell us where we are heading and how to drive. 20% is about using the mirrors at important times to avoid accidents. Imagine the result if you tried to drive your car using the rear view mirrors 100% of the time. This is effectively what you are doing when trying to trade solely off a price chart. In the world of retail trading education, there are many myths concerning fundamental analysis and trading of news. For example, many people believe that fundamental analysis is complicated or reserved only for those that have specialist degrees in finance. Other people believe that trading around news events is highly unpredictable and dangerous. And some people are told that all information is perfectly priced into the markets at any given time. These are all retail trading myths, and one of the best ways to see how this is the case is to simply watch the price of major currencies as a major economic event is released. You will often notice that the price moves almost instantly in reaction. These moves are the direct result of professional traders waiting for these releases and taking action. They do not hide or avoid these events. In fact, they are often the highlight of the week for most professional trading floors. If this is how professional traders operate, then it gives us a clue to the importance of fundamental news and analysis. Later in this course, we will also demonstrate how news and fundamentals very often take months and even years to be fully priced in. This is very easy to prove, and we will use a real-life example on a major currency. After you see for yourself how simple and effective the fundamentals can be, you will then be ready to understand exactly how you can start using them to vastly improve your trading. So how can you begin conducting some basic fundamental analysis now, and what do you need to be watching out for? When trading currencies, everything revolves around the central bank of the relative country. A central bank is responsible for the economic stability of each nation. Famous examples of central banks you may have heard of include the Bank of England and the Federal Reserve in the US. Each central bank has a mandate. This is just a selection of targets for the overall economy. These targets generally revolve around how many people are employed, how fast the economy is growing, and how quickly prices are rising for normal, everyday people doing their shopping. To help them make sure that the economy is working in a way that will keep to their targets, they monitor the economic data that is released on a regular basis and then try and use that data to spot trends in the economy. When they see a trend forming that they don't like the look of, they will then use some of their special tools at their disposal to fix it. The process of a central bank is fairly simple. They set their targets, they monitor the economic data, they implement their tools when they see the need to. So how does this help you as a trader? It is the use of these tools that causes currency prices to move. The most common tool used by central banks around the world is that of interest rate adjustments. One way in which they can adjust interest rates to improve the economy is when people start saving their money instead of spending it. When this happens, the economy starts to slow as fewer people are buying and selling. As the economy slows down, more people stop spending and it gets harder and harder to make money. The worry of not being able to make money then leads more people to cautiously save the money they do have, thus growing the problem. To nip this in the bud quickly, the central bank will lower its interest rate. This is the rate used by all commercial banks as a guide from which to pay its savers and charge its borrowers. By suddenly having a lower rate, it makes saving money much less attractive because people get no reward. It also encourages people to take more risk and borrow money, which they then use to buy houses or start up new businesses. This gets the money flowing and people become confident that they will be able to make money again. This confidence leads to further spending, which gets the overall economy back on track. Each time the bank implement their tools in this way, it has a powerful effect on the value of their currency. The example we just looked at of lowering interest rates would also reduce the value of the related currency, sending the price plummeting. The reason is that investors would suddenly have no benefit of saving or investing their money in that country. The interest they were previously being paid is now gone. Instead, they cash out and move their funds to another country where interest rates are more attractive and they will get a better return. Part of this process involves changing that money from the local currency into the currency of the new country. They are in effect selling the local currency to buy the new one. This selling of the currency causes the price to drop. Imagine the advantage you would have if you knew how all of this worked and began selling that currency just before the rest of the market and the larger investors had a chance to do all of this. This is where understanding and trading the fundamentals will make you money. Let's look in a little more detail how all of this works and how you can start learning and applying it today to improve your trading results. As we know, it all starts with that economic data. But instead of being mysterious numbers that have a totally random impact on the markets, they can in fact be followed, interpreted, and even predicted in the right circumstances. So what are these economic data points, and what do they tell the central bank and us about the economy? The main ones can be broken down between production indicators, which show what the country is making, employment, which show how the workforce is performing, growth, which shows how fast and at what rate the economy is expanding or shrinking, inflation, which show the rate at which prices of everyday goods and services are rising or falling, and finally, geopolitical events, which isn't directly related to the economy but can potentially have a huge impact if, for example, a country goes to war or if an anti-business government is elected, and this could cause problems that the central bank might have to contend with. When these indicators point to action being needed from the central bank, then this will move currency prices as traders try and get into position to ride the moves for as much as they can. This race to catch the next big move is generally what is moving currency prices on a daily basis as professional traders constantly analyse the economic data and try to predict when the central banks will act next. Very often, the moves caused by the speculators creates opportunity in itself. If you learn to recognise things that the market might be paying attention to, or something that has historically caused traders to buy and sell, then this is an opportunity to take advantage of, just like the anticipated moves caused by the larger investors moving their capital in and out of the country over the long term. This is why news is never fully priced in instantly. Sometimes it just takes a while to move huge amounts of money around, and this drags out the time it takes for things to ever be fully priced in. This brings us to the tools themselves that the central banks use. The main tools are interest rates, as we've already looked at. The bank also use price caps, which is when they will decide to keep the value of their currency at a specific price level against another currency. An example of this was on the Euro-Swiss franc currency pair in between 2013 and 2015, when the Central Bank of Switzerland, the SNB, decided to hold the value of the Swiss franc against the euro at 120. Even though the market wanted to sell that pair lower, it couldn't because the bank would literally print money to absorb all of those sell orders. This was one battle that the market knew it couldn't win. This was a powerful tool, and traders knew that when the price hit that 120 level, there would be renewed buying from the bank and it would rise back from it. The power of the bank's floor was demonstrated when they removed it in 2015. The price fell over 10,000 pips in a matter of minutes as the markets scrambled to take advantage of the removal of this tool. Another tool used by central banks is that of language. This simply involves trying to convince the market that they will do something if needed, in the hope that the market believes them and starts trading as if that action had been taken. For example, if a bank would like the value of the currency to be lower, but doesn't want to actually lower interest rates, then it could tell the market that it will act unless the price falls. If the market believes the bank, then very often it will oblige and sell the currency, thus giving the bank its desired effect without them having to actually do anything. These messages are delivered through regularly scheduled statements that the banks all host. It is not hard to figure out what the banks are thinking because they go to great lengths to actually tell us. There are many other tools that banks can use, but these are the most common. And in the years after the financial crisis, they also started using a new tool called quantitative easing. This is where they print money and flood the economy with that new money. The goal is to reduce the value of the currency while also stimulating the economy. So traders are constantly looking for any signs that a central bank may be about to use one of these tools, and then will try and trade that ahead of everyone else. The earlier they can enter, the more of the ensuing move they will catch and profit from. Your job as a trader is to be aware of what is going on and then figure out what the central bank is likely to do next with its monetary policy. If it is likely to take action that will devalue its currency, then we would be looking to sell it. If it is taking action to increase demand and therefore the value of its currency, then of course we would be looking to buy it instead. This constant cycle of economic data and the central bank's reactions is never ending, and is what provides unlimited opportunities for currency traders all over the world that understand what's going on. There is no need to try and follow every analyst or be watching every single movement of all the currency prices. The only thing you need to be aware of is what each major central bank is doing and how the market is expecting that to impact the currency. Once you become proficient at this process, you will start to see many opportunities to make money from your ongoing analysis across the major currency pairs. You can get started with this right away and see for yourself just how connected the economic news is with the movements seen in currency prices. To do this, you can follow a simple 4-step guide that we will walk you through now. Before you can apply these 4 steps, you will need to know where to find the necessary news and information. There are many freely available resources that you can start using right away. These will help you start using fundamental analysis even if you have no experience in it until now. Below this video, there are some links to the most popular websites that regularly provide news and analysis articles that we can use to find trades. The following 4-step guide can be applied on any of these sites when reading the articles that you find there. If you cannot apply each and every step to the information that you're reading, then you should abandon that particular piece of information and find one that does contain each of the 4 steps. Step 1. Which currency is it talking about? When reading a piece of fundamental news or analysis, the first thing you need to find is which particular currency it's talking about. This will usually be in the headline or first few lines of text. Step 2 is which direction is the currency moving in. Now you know which currency the news is moving, your next step is to find out which way is expected to move next. This should again be either in the headline or the first few lines. Step 3 is what are the reasons behind this latest move. This step is very important and is perhaps where most retail traders go wrong when trying to find trades. The reason behind why the price is moving is absolutely crucial to understand and will really help you figure out what to do next. You will discover the reason behind the move by reading the main article itself. And step 4. What are the analyst expectations from here? This will be where you start to understand how to interpret the news. As a beginner, the best path is to simply follow along with what the expert analysts and traders are thinking. Each article should contain a specific expectation that you can use to base your own trading on. For example, do they expect the moves to continue, or do they think it's merely a pullback against the main fundamental trend? This will tell you whether to buy or sell. They will also very often give you specific price targets for that specific currency pair. These targets are only general guides, but can give you a nice idea about how much of a move can be expected. In the next video, we will give you another step-by-step guide to actually taking a trade. This will walk you through the process we've looked at in this video and then show you what to do once you are ready to pull the trigger. In the meantime, you should click the links and start practicing your own fundamental analysis by following the 4 steps that we've outlined here. After a few days, you will start to see just how directly the fundamentals move currency prices every day. This is your key to making consistent money from the FX markets and finally leaving behind the damaging cycle of switching that has held you back until now. In the previous videos, we looked at the top 3 mistakes that you've probably been making as a retail trader, and most importantly, what you can change right now to improve your results. The key to trading profitably is the application of fundamental analysis. We also covered some of the things that move the prices of currencies and how you can start conducting fundamental analysis right now to profit from those moves. In this video, we'll be looking at a 3-step guide to help you actually find a trade once you've identified an opportunity based on that long-term fundamental outlook. We will also be introducing you to an extremely important concept called sentiment. This is going to be vital to your understanding of how and why currencies move on a very short-term basis. If you want to be a day trader and you do not know about sentiment, then you are doomed to fail from the very start. So let's begin with the 3-step checklist that you need to complete when looking for trading opportunities based on standard fundamental analysis. Trading with the longer term fundamentals is perfect if you have a full-time job or if your schedule only allows you to engage with the markets on a part-time basis. The first step we're going to look at when trying to find a longer term opportunity is that of finding the cause of the most recent price move. This will tell you a lot about whether or not there is an opportunity at all. For example, if your fundamental analysis is telling you to look for buying opportunities on the pound versus the US dollar currency pair, then you need to take a look at that pair and see which way the price has been moving. If the price has been falling or moving in the opposite direction to the long-term fundamental outlook, then this could potentially be a great opportunity to start buying it back at a much cheaper price, which in turn will give you a very reasonable expectation for making money as it starts moving in line with the overall fundamental picture once again. You need to be cautious, however, because there is a chance that something may have happened that was previously unexpected by the market that could suddenly change that overall fundamental picture. This, of course, could lead to you losing money as the price keeps on moving against the anticipated direction. This is why understanding the reasons behind the most recent move is so crucial. You're trying to assess whether or not the market is simply trading in a way that gives you a better price or telling you about a shift in the fundamental picture. The second step is to fully understand exactly what the big picture fundamental outlook actually is. The best question to ask at this stage is, what is the central bank most likely to do next with their monetary policy? And is that likely to be positive or negative for the currency? The answer to this question is heavily related to the answer to the question we asked in step 1. This is because if the reasons the price has been moving recently do not change that big picture fundamental outlook, then we have a clear opportunity to buy or sell this currency pair back at a nice, better price. Getting to grips with this concept of changing outlook is one of the most important elements of trading the fundamentals. Once you master this, you will have a very solid way of valuing currencies and identifying profitable trading opportunities. There is, of course, a third and final step to finding a great trade opportunity when using fundamental analysis. And this step is all about finding a good entry point. Getting into the market is important because it will determine how much you risk and also how much profit you will make. Enter the market at a bad price and you will have a higher chance of getting stopped out and also a lower profit potential. If you can secure a good price, then your stop can be much smaller while allowing you a much greater potential for making a profit. So what's the key to finding a good entry into the market? The answer lies in letting the market show you where it believes the best entry prices are. And this is where the concept of technical analysis can be so useful. Imagine if you had a special book, and in that book it contained all of the prices and you could see at which prices the market had been buying or selling. Crucially, imagine being able to see how much buying or selling had taken place at each price. This information would allow you to get a very solid idea of where the markets might have their next set of buying or selling orders ready and waiting. If they are all buying from a specific level at a specific time, then this is where we also want to be entering the market so that we can ride the wave that follows and make money. Technical analysis is a very popular concept and has merit, but it is something that most retail traders over-rely on when trying to make money. The traditional issue that most technical traders face is simply not knowing which of their signals to follow. Do you only take the buying signals or the selling signals, or do you just take them all? Of course, if you've been trading solely based on technical analysis, then you will know of the frustrations this can cause. Some days you will miss the best moves, and other days you will get cut to pieces as the market just ranges without really moving anywhere. But imagine if you knew the overall direction, thanks to your fundamental analysis, and your job was to simply take the signals in line with that direction. Suddenly, you're able to identify days when there could be a lot of volatility, and also those days where the price will most likely just stay range bound. This allows you to focus much more on taking only the highest probability signals at the correct time. You may have noticed that it really doesn't matter which technical strategy you use for this process. The key point is that you are adding in fundamental analysis to improve your overall results. If you do have a technical strategy that you enjoy working with, then that's great, and you should stick with it as you start to implement fundamental analysis alongside it. If you do not have a particular technical strategy that you use, then we will provide you with one that is commonly used by professional traders inside firms and banks. The process is remarkably simple and brings us back to the illustration of that special book that tells us where the market has previously been buying or selling from. In reality, we do not need a book because a simple price chart can give us that same information. When looking at a common candlestick-based price chart, you'll be aware of certain areas that the price reacted from. This is essentially showing us the exact price levels that the market has singled out as good places to trade from. It makes sense that if the overall direction is still the same and the fundamental outlook has not changed, that these prices will remain attractive to the majority of large market players. When these price levels are hit again, it makes perfect sense that they will once again look to enter the market just as they have recently done. This concept is known as support and resistance and can be used for buying and selling in equal measure. The key to using these levels is in your overall analysis of the bigger fundamental picture. As long as this has not changed, then these levels are golden opportunities to trade with the rest of the market and ride the waves caused by all of this activity. This might sound remarkably simple, and it is, but only once you have grasped the concept of correctly understanding the fundamentals. Trying to trade these levels randomly or in the direction of trends derived from purely technical sources will inevitably lead to the same frustrations that you may have already experienced. This frustration leads to a lack of confidence in your trading, which in turn leads you right back to that deadly cycle of switching strategies and losing money. This combination of understanding the markets and knowing which way the currency should be moving, and then searching for an entry based on where the markets have already shown their interest, will almost immediately improve your results. Go away and test this out over the next few weeks and see for yourself. As mentioned, you do not have to trade from support and resistance and can instead use the many myriad of technical strategies that have been invented by the retail trading education industry. But always remember that the ratio of analysis that you use should remain 80% fundamental and 20% technical in order for you to see continued, sustained profitability over your trading career. This combination applies to longer term trading strategies, but also to shorter term trading too. As we discussed at the start of this video, we are going to introduce you to a concept called sentiment. Sentiment is something many retail traders overlook or are not even aware of at all, but it is essential to anyone that wants to understand how the markets move on a daily basis throughout each of the major sessions. One of the questions we get asked on a regular basis is how do professional traders know which currencies to trade and which way to trade them as they sit down at their desks each morning? The answer is sentiment. Sentiment is one level up from fundamental analysis. Whereas the fundamentals focus on the facts surrounding which way currencies should be moving, the sentiment focuses on which way they actually are moving and the reasons why. Sentiment simply means the mood of the market. So just like people have different moods and emotions, so does the market. because after all, the market is just a large group of people all engaging with one another electronically. A classic example of this changing moods is something called safe haven plays. A safe haven play is where the markets buy a currency that is viewed as strong and stable during times when the overall economy is viewed as weak and unstable. Traders and investors want security for their money. Certain currencies are traditionally known as safe haven currencies. For example, the US dollar, the Swiss franc and the Japanese yen are generally regarded as the safe haven currencies where investors flock to shelter from short-term economic storms. Very often we see situations arise where the fundamental picture for a currency is very much negative and we can reasonably expect that currency to weaken. In a hypothetical example, we can take one of the safe haven currencies such as US dollar and imagine that the long-term fundamental outlook suggests that the currency will most likely be sold off and decrease in value. This means that we could be looking for scenarios where the currency is rallying or increasing in value so that we can then sell it again at a better price. This would work well in normal circumstances when the markets are trading basic fundamentals. If, however, there was a sudden unexpected event that caused the market to panic, things would change, both quickly and drastically. For example, if a major conflict broke out between two large nations, or if there was a serious stock market crash, the markets may panic and flock to their traditional safe havens. In our hypothetical example, you may be selling the US dollar as this starts to play out, but because the market is in a negative mood that is solely focused on protecting their capital, they will probably ignore the long-term fundamentals of the currency in exchange for the safety and security that it offers in the short term. This will cause the price of the currency to rapidly increase in value for as long as the market genuinely believes that it's a risk. If you are oblivious to the concept of the market experiencing large shifts in mood or sentiment, then you are at risk of losing money when this happens. In our example, the US dollar would continue getting stronger and stronger while you continue to look to sell it. This can become dangerous, confusing, and damaging to your account. As a long-term trader, you should be aware of the concept of sentiment and also tuned in to what mood the markets are currently in. This will allow you to assess the severity of the situation and whether or not you are seeing what you're seeing is really a great opportunity or something you simply want to sit out of until the markets refocus back onto the fundamentals. If you're a short-term day trader, then these mood swings will become your bread and butter. The longer-term fundamentals become less relevant because you can make profits riding these moves as they happen, even if they temporarily go against the overall picture. The key, of course, comes back to having that understanding of the markets and then knowing how to trade that and take advantage of those opportunities. Whether or not you're a part-time trader or a day trader, an understanding of both the longer-term fundamental picture and the current short-term sentiment of the market is going to be pivotal to your success. Now that you have the framework for understanding the market and finding trades, the final video will walk you through a real-life example of how the long-term fundamental picture played out and how this was regularly interspersed with short-term shifts in market sentiment. There were many opportunities to make a profit, and anyone that understood exactly what was happening had the perfect vantage point to do just that. In the previous videos in this course, we looked at the top mistakes that you have probably been making and how you can start applying fundamental analysis to your existing trading to improve your results. We walked through some step-by-step guides for analysing the fundamentals and finding trade opportunities. In this video, we will show you how the fundamentals play out in real life by taking a look at a classic example of central bank monetary policy in action. We will also see how short-term sentiment can impact these moves and how all of this can give you many fantastic opportunities to make money once you understand how it works. By the end of this video course, you will have the complete framework for understanding how the fundamentals work and why applying this type of analysis will give your trading performance a clear boost. We will begin by taking a look back to the beginning of 2013. In April of that year, we had a very special announcement from the Bank of Japan that would give us a long-term trading opportunity for many months ahead. Leading into this announcement, the economy of Japan had been sluggish and growth had been barely non-existent. To counter this, the Central Bank of Japan announced in April 2013 that they would be conducting a large-scale program of quantitative easing. Quantitative easing is essentially the act of printing money and then injecting it into the economy. Most central banks will take this money and start buying up low-risk assets such as government bonds. This has a double-edged effect. On the one hand, it increases the price of these bonds, which also means that the returns an investor can get from holding them become much lower. On the other hand, it actively devalues the related currency. This is down to the simple laws of supply and demand. When supply goes up, the value naturally starts to fall as demand cannot keep up. Lower bond yields and a weaker currency have an interesting effect on the nation's economy. First of all, it encourages the investors to move away from bonds and start investing in other things that will provide a fairly stable profit. These things often include property and stocks and shares. This has the effect of increasing the value of those assets too. All the normal everyday people that own their own house get a very nice boost as the value of their property increases at a rapid pace. As the currency weakens, it makes it much easier for businesses to sell their goods to foreign consumers, which boosts sales, revenues, and profits. This helps companies to expand and drives growth in the economy as a whole. The net result is that the economy is much more buoyant and less sluggish than it previously was. As Japan initiated this program, professional currency traders knew about this and began positioning themselves for the big sell-off on Japanese yen that would surely follow. The best part is that the Bank of Japan even gave the market a specific price target for the US dollar versus Japanese yen currency pair. They stated that they wanted the pair to reach at least 110 before they would even consider halting their program of printing money. This gave the markets confidence that the move would last a long time and that the banks were committed to their goal. It also gave them a firm price target to aim for and base any trades they took around. This move didn't fully happen right away. Instead, it took several years to play out and provided many opportunities for traders to enter the market and make a profit. If you take a look at a price chart for the US dollar versus Japanese yen currency pair, you will clearly see how the markets reacted on April the 4th, 2013, which was the day of the announcement. The price of the dollar yen had been around 92. In the first 24 hours, the price increased to 96. This brings us back to one of the most common myths surrounding news and fundamental analysis, that all news is priced in at all times. This example illustrates how this is completely false, and that when a strong central bank policy change occurs, the move can play out over a very long period of time. In fact, it took around 18 months for the US dollar Japanese yen pair to hit that 110 target set by the Bank of Japan. Imagine if you knew that the pair was heading higher based on these fundamentals, and you then had 18 months to take advantage of that fact. This is how it is possible to trade around a full-time job or other commitments. You do not necessarily have to be sat in front of the screens full-time to make money from trading the fundamentals. The moves on dollar yen following the announcement from the Bank of Japan also show us how it is possible to use sentiment for trading short-term shifts in the mood of the market. You may remember from the previous videos that sentiment is simply the current mood of the market, and the mood of the market changes frequently, just like the mood of a person would. The markets are just a collection of people after all. If you do have the ability to trade through the daily sessions, then this could be another very powerful way to make money off the back of these fundamentally based moves. To illustrate this, using the same dollar-yen pair that we've been looking at in this video, we're going to look at the very common phenomenon of safe haven plays. This is something we also looked at in previous videos. This is something that regularly occurs when the markets fall into a negative sentiment that is driven by fear or panic. When this occurs, the markets tend to flock to currencies that they believe to be safe and secure. One of these currencies is Japanese yen. This creates an interesting dynamic because we know that after April 2013, the long-term direction of the yen was most likely lower, but occasionally we could have a situation where the vast majority of the market were buying it as they sought shelter from short-term economic risks. As a trader, this simply means more opportunities to make money if you understand how the markets operate and what to look for. For example, if you are a longer term investor operating on a part-time schedule, then you can use these temporary periods of buying in the Japanese yen as opportunities to start selling it again for when the long-term fundamentals start to play out once again. If you're a short-term trader that is actively engaged with the markets, then you trade around these events and make money both ways as the market's mood changes back and forth. To illustrate this, let's take another look at the dollar-yen pair. You can see several occasions where the price of the pair reversed against the anticipated upward trend. These reversals were great trading opportunities for short-term traders that are in a position to monitor the sentiment and trade in line with it, taking their profits in between the larger moves. This also helps to demonstrate that fundamental moves are not simple and linear. Just because we expect the pair to rally over the coming months, it definitely does not mean that it will simply go up every day. Long-term fundamentals will always exist in the background, but the short-term sentiment of the market will change regularly alongside it. You need to be tuned in and focused on the sentiment of the market and understand the overall fundamental picture so that you can spot any opportunities that come along. You should always know if a current price move is in line with or against the big picture fundamentals. This alone will result in a marked improvement in your trading as you begin to really understand how and why the prices of currencies move in the way that they do. Of course, both techniques require the skill to be developed over time through dedicated practice, but that skill is then with you for life, and you can trade any market and any asset class once you understand how the market operates and what drives it. There are many more examples of how central banks operate, and almost every major currency is cycling between positive and negative central bank policies. The entire FX market is focused on trying to figure out which way the central banks will go next with those policies based on the economic data that is released. The information within this video course has been designed to help you clearly understand the things that have been holding you back, but also how to apply fundamental analysis correctly. Now that you have a clear overview of the most important concepts, you can set about practicing the steps that we have shared with you to see for yourself the difference it makes to your trading.